My name is Brandon Lehman. I'm the director of Annex Private Client. I've been doing this for 16 years, 17 years now. I can't remember. I started in 08 when the world was falling apart. I thought I was going to go to school to be a lawyer. Luckily, that didn't work out, so got that going for me.
Thanks.
Yeah. So I primarily work in the high net worth space. I do a lot of transition planning for clients who are looking to sell, particularly going down the path of how do you manage selling the business tied to your personal life, and how do we work those angles, make sure everything works out for you but works out for the business and the clients. The other thing I do is I serve in the Army Reserves. I've been doing that for 10 years, I think. I got back in 10 years ago. So if I get right to the point, or KISS, keep it simple, stupid. That's kind of how I function. I also just got off of service on Sunday, so it's kind of hard to kick that out of your system right away. I mean, it's only 2 days reserved from being a soldier. Alec, you can go.
Yeah, so I'm Alec Durand. I'm one of the estate planning attorneys at Annex. I primarily work with our comprehensive wealth group. Estate planning, people think trust and wills, but a lot of it interacts with business succession planning as well. How are you going to leave a business? Who are you going to leave it to? Do they want it? I do occasionally help out with Brandon in our private client group as needed, but a lot of my work focuses with, again, the comprehensive wealth group. Notices here, we're not a law firm, so even though I'm an attorney up here, I can't give any of you specific legal advice. We don't draft documents for clients. We're primarily in an advisory role, explaining impact of decisions, pros and cons, alternatives. We focus on planning.
All right, so the agenda, we can keep it long, we can keep it short, we can keep it conversational. You get to choose. But the thing we're going to go over: transitions, the process, the challenges, monetizing the business, and then succession planning. We do a succession planning discussion. We actually ran a webinar about that late last year. So if you want to talk about that, we'll kind of get into the deep sides and the emotional sides of succession planning. As somebody who comes from a family business, it gets to be very interesting. So, I mean, one of the things that we know is 100% of all business owners are going to have to exit. You have your option to exit, or the option that happens automatically when you're done, and then somebody else has to take over because you've passed away. So death is an actual succession plan. Probably not the best one. We wouldn't recommend, but you do you. Choose what you want. But otherwise, obviously, you have individual sales, which we've seen out there, third-party sales. The private equity side of the house, transition to employees in the ESOPs, and then family business to the next generation, right? We all hear that third generation is typically where things fail. So if you're looking at that and that's a concern, how are you going to do that? What are you going to think about? So second question we get when we work with our clients is they say, well, how long is this going to take and when should I start? And, the canned answer is, right, if you planted a tree 30 years ago, it'd be fully grown, or you can plant one today. What's the best time to start? Well, right now. Like, you should start as soon as you can. And it doesn't necessarily mean that you started your business today and you're thinking about selling it tomorrow. You want to take the time to think, what could this look like? What do I want to grow it into? And what should I do to make sure I'm not the person that is the value of this business, that when I leave, there's no value? So you start to think about that. You start to put that plan in place now. And we like to say at least 5 years ahead of time. So the gentleman in there who just retired, said he took 5 years. I'm glad he said 5 years, because that's really when we start to push people. If you're serious, that 5-year mark, there's a lot of conversations to be had, and you still need to run a business. You still need to grow a business. You still need to be successful. There's so many things that you have to do that this doesn't necessarily fall to the back burner, but what happens is you can't fully focus on it. So it takes time, it takes energy to do this, and you need to make sure you have that time. So we were just working with a client, very large conglomerate of corporations, and they're like, we want to retire in 2 years. That was the first we'd ever heard it. Like, it was prior to that, we weren't allowed to even talk about retirement because it wasn't going to happen. And now all of a sudden it came up because of health issues. Health became a concern. We needed to sell. Well, 2 years for a conglomerate of multiple businesses owned under a holdings company is a short amount of time to value, get it all put together, and then figure out the personal plan along with the estate plan, because the estate plan in that situation is an absolute mess because they focused on their business. Nothing wrong with that. But we need to make sure all these things are running concurrent. So when you work with a firm, right? And I got to have a plug in here somewhere. But when you have an advisory firm, that's what we have to do for you. We have to focus on that and let you run the business, and then we just poke you constantly. Hey, did we get this done? Hey, let's go schedule that meeting with Reinhardt or whomever you work with, Mather Group. Whatever we have to do, we're going to poke you and just make sure that gets done and then follow up with that. Because if you're not, another horror story. So we had same thing, a health issue. They immediately had to sell. This was a non-negotiable. Like, they had to get out, or unfortunately the owner's health was deteriorating rather rapidly. So they did a fire sale, and they had no plan in place. As we talk about monetization and how these things look, it all, I don't want to say fell apart, but it wasn't what any of them had envisioned after running a business for 45 years. That's not the norm, but unfortunately, I would say 20% of the time I see that. And it's really hard to explain to somebody you've been making and cash flowing $500 to $1 million a year, and you just sold your business for $5 million. That's it. Now we got to pay taxes. Now we got to pay all these other items, and you're used to living off $500,000 a year. I'm sorry, your new budget is going to be 200, maybe. Those are hard conversations to have if you don't start planning. So the big thing is we have to set everybody up for success, and that's our job, is to set you up for success. Your job as a business owner is to make sure that everybody else is set up for success if you want it to be successful. It's only happened to me once, but I did have a business owner who's like, I'm out. Like, just got that check, left, and it was very interesting on how that panned out. I don't think the PE firm was happy. But maximizing value for the buyer, right? So you start to look at how are ways that we can improve efficiencies. How can we make this better? But how can you remove yourself? They always say you hire people that are smarter than yourself, because if you hire people that are smarter than yourself, they can take that business, they can run with it, and you can slowly remove yourself, but still be the owner and keep the value in the business. Because there are a lot of times where the value rests with the individual. That individual exits, you lose that value, particularly if it's like a services industry, right? You're the sole provider of that services, or you're the SME, the subject matter expert. So you have to make sure you pass that along and grow that enough, and have that time frame, that 5 years maybe, of those people to become the new experts, and your clients to look to them as the experts, not you. So the other thing is I talked about it, is you look at the loss of cash flow, right? When you're a business owner and is successful, I want to be very clear, right? You're down this, you've built this business from nothing, blood, sweat, and tears, and now all of a sudden it's been cash flowing. You're used to this lifestyle of great cash flow, and you're pumping the cash flow back into the business, or you have owner's privilege, right? Everybody knows what that is. Your cell phone, your gas, your random things that flow through the business. In my family, when my grandfather was in charge, like our toilet paper and the train that went around my Christmas tree, which I still have to this day. My grandpa retired in 2001. He'd go to Sam's Club and buy everything for everybody, all the aunts, all the cousins, everybody. And that showed up on the business, 100% under the business. But those are the things that you have to consider. Again, we just dealt with somebody who did the same thing. They worked in a construction industry, so the cars could come through the business, the trucks that they own could come through the business, the repair. There are so many things that flowed through that business. So when we asked them what their budget was, what did they need to survive, they'd be like, "Oh, my expenses are $3,000 a month because I don't have any expenses." I'm like, "Yeah, that is not true. We need to tie this all together." And then you start to really dive into it, and they go, "Oh, wow, I spend that much?" That's usually the first thing you say. I spend that much? Or the next question is, where does it all go? Like, well, let's look at your credit card statements. And the beauty of what we do is they'll actually open up to us because they want to make sure they can retire. Because the one thing that you need to do, and we'll get into it, is you need to figure out what is your number, right? You could get an offer today, but what if that offer isn't enough? And we have to tell you, we'll tell you flat out, if you got X, we take out taxes and we take out whatever else you have to do, this is your net number. Can you survive off of that? And let's assume a 4% withdrawal rate, based on normal financial planning rules. Is that going to work? And when you show them that math, because we have the ability in software, and that's the beauty of technology today, to put it right in front of you and say, this is the no nonsense, this is what you get, and this is what it lasts for you. And they go, that's not going to work. Well, then let's find a way to maximize this business. That's when we get with some of our partners. There are consulting firms that we will go call on and say, hey, I know it's going to cost you money today, but if you hire them, it's going to make the business that much more valuable. It's going to be worth it. Again, picking on just the family business here, who's going to stay post-transition? We just did a really big transaction I guess it was in 2021, where one of the family members stayed behind. They still work there to this day. They were set up and it worked out really well for them. Everybody else left, but they were able to stay and build themselves a great brand. Their brand grew inside the company, and they've grown up now over the last 4 years and moved into a senior management position where before they were in sales. So it's just who's going to stay. And then the last one, depending on when you exit, what are you going to do? So a term we like to use is you're going to retire to something, not from something. So yes, if somebody walks in and offers you a check of some absurd multiple of your EBITDA and you're like, yeah, I'll take that. Well, that's a little different. But if you're looking at this trying to move on, what are you going to move on to? Are you going to invest in another business? Something that we see a lot of is folks, they have an expertise. They were really good at what they did. So they say, well, how can I help somebody else? The gentleman that was just in there. How can you help other people? That's what we see a lot of former business owners do. They take the time, right? They take time off. They're like, all right, let's catch our breath. Let's travel a little bit. And then they get antsy. And then they start to look for people to help. And they look for a way to make a difference and grow other businesses, which is probably one of the funnest things to see because they find that younger generation and they go out and they make a true impact. Other people just move down, and we were just talking Naples, Florida. They just moved down to Naples, Florida and drive up and down 41 and show off their really beautiful cars. All right, so during the operational years, the only thing you're worrying about or thinking about is how to operate your business. Our job, or that team of experts you put around you, is how to make sure your personal life is flowing and working just as good as your business. So how do we look at it? How is income going to flow through? How are you utilizing strong income years versus low income years? What are we doing for tax advantage situations? Are we taking losses in the right spots? If you're a sole proprietor in LLC where it's just you, how are you utilizing solo 401ks? How are you utilizing cash balance plans? Because the other item I've seen from very successful business owners is they actually don't save. They save their 401k because they don't have a safe harbor plan, so they're hit with a highly compensated employee and they can only put in X amount based on their employees. But they don't really do anything else than that because what they're doing is pumping it all back into the business. So you need to take that time to think about how much can I take for myself in case this doesn't work, so I can have a savings put aside. That's where it really comes down to just proper tax planning and preparing for that transition of the business. The year of the sale, all right, so what are we going to do? Charitable planning is an absolutely huge opportunity right now under the current tax laws. It's kind of the only opportunity that exists. You don't have much else when you have high income years because you have donor advised funds, you have foundations, you have flat out giving to charity. If you're over 70 and a half, you have qualified charitable distributions. But really, other than that, how are you going to knock off taxes? There's not a ton of levers to pull under the current tax laws. So the other one that everybody thinks is really easy is moving to Florida, Tennessee, Texas, Wyoming. It's not. Wisconsin wants their money and they will get it, and they will find a way to get it, and they will question everything you do. We were just filing taxes for somebody who moved to Florida last year, and they didn't have any of these events. They had sold their business years ago, but just the process to get that domicile approved through the state of Wisconsin and to show they have to prove what dates they were there, how long they were there, what dates they were in Wisconsin. All of that goes on that tax return when you file that domicile change. So just things to consider. And then, so what are you going to do? One of the best options I've seen when people actually get out of their business is actually consulting. So this is a great opportunity to get into that side, and we start to do advanced tax planning, right? So you had a great year, you had your windfall, the sale of the business, but you still have that itch, you still have that ability to add value, particularly if you're a subject matter expert in very specific areas. I had somebody in the natural gas and fuel industry. So what they went into consulting, and they were making more as a consultant, but then we utilized cash balance plans and solo 401ks to kind of put that all back in, keep those income taxes low and live off the portfolio, and then utilize it through a charitable giving plan. So there's There's a multitude of angles you can take. Real estate is a huge one that everybody likes to do. If you can be a qualified real estate investor and go through that process, and then you own separate LLCs and you're managing it as a property, a lot of tax advantages that can be had there if you're doing it properly. It's complex. There's different things to pay attention to, but when you meet entrepreneurs and you meet business owners, they're never done after they're done. They're done for a short time, but then all of a sudden they want to do more and they want to do more. And that's where you can have a lot of fun, because you're out of the W-2 world, meaning you're limited to what you can do on your W-2, and we can start thinking about advanced tax planning strategies. All right, so how are you going to structure this sale? Well, is it a stock sale? Are we doing an asset sale? Is there some goodwill built into this? Lump sum versus installments. Lump sum payment is great. You get your cash all up front, or do you want an installment sale with some interest tied to it, with prepayment penalties maybe? Those are discussions that you have to have. And when you start building that out, you can actually see how that's going to impact your life from a financial planning standpoint. From like, if we're getting this amount per year, we lose this amount to taxes, this is our basis, this part was goodwill, how does all that work? What does that mean for us? Or do we just get a check for $25 million and move on with our lives and pay the taxes because it's all long-term gains because it was asset? Now, the buyer is going to want something different. The buyer might want an asset sale to depreciate. It's all going to depend, and you're going to want what's best for you tax-wise. The buyer's going to want what's best for them, and your attorneys are going to duke it out. The other thing is, how can we protect as much? How do we protect this? Let's be honest, you don't. There's not much. You can't truly protect your asset. Like, Uncle Sam's going to get his fair share. Like, it's just, he's going to. Right? And I appreciate it. It means you're paying my other salary in the Army. It's great. But he's going to get his fair share, so just acknowledge that right away. But how can we structure it the best? That's between us working on your behalf, your amazing team of CPAs, and your amazing teams of attorneys. To go through this process, before we get to this, when you go through this process, you have to build a team around yourself and realize that paying for that team is going to pay for itself in the long run. A good attorney, good CPAs, good planners are going to make the difference. Yes, they cost money. Pay once, cry once. It really matters in this industry because they're going to look out for you and they're going to help you get to the right spot when you get really good ones. And the beauty of Wisconsin is we have a lot of really good people in all those areas at a lot of really good firms. And if you're in a particular like trucking industry, I know somebody for you. If you got somebody in manufacturing, ask me. I got somebody for you. Like there are people that we can point you to that'll help you down that path. But you have to build that group. That's that question of how do we protect from Uncle Sam? That's how you do it.
Sorry, on that, just one more thing. Deal fatigue was mentioned a lot in the panel and the keynote speeches. Getting that team around you can help with that. If you have experts to lean on, it can take some of the burden off of you. It's worth paying to have a great team around you to help with the deal.
So maintaining your lifestyle is going to be key. You want to maintain your lifestyle. So how do we do that? It comes down to planning. What do you need? How much is your business worth to you? And what do we need to generate to maintain that lifestyle? How charitably inclined are we? Do we want to be philanthropic? Do we want to leave a legacy? Your legacy and your name is tied to that business until the day you walk out of that business, and then it's not. Like, again, my family's been in business since 1945. Our name is tied to that. That's how we identify ourselves as a family. But the second we walk away from that, we lose our identity. So what's that identity going to be? Is it going to be philanthropic? Is it going to be building a legacy through your kids? Is it going to be going out and helping another business? You have to think about those things. Those are hard questions to answer because all of us are identified by our work. Like, I identify as somebody who works in finance and is a captain in the United States Army. Like, that's my identity. That's who I am. And as soon as both of those things go away, I have no idea what I do. I don't know. I don't play video games, so I guess I read books, maybe. Ride horses. I don't know. So those are, again, things that you have to start to think about, and you think about now. You start to think about well before you actually pull the trigger on all this. Because if you don't, and you walk into that first day with nothing to do, you get stir crazy. You get anxiety. There's a lot of uncomfortable feelings that come from that I've experienced in my 16, 17 years of doing this, of watching people go through this process. All right, and this is how you figure it out. Where do all these things intersect and what do you do? So what type of legacy do you want to leave? Do you want to be philanthropic? But how do you maintain the lifestyle you want? And for some people, that lifestyle is extremely extravagant and they got to go back to work. And for some people, I met with somebody recently, their annual budget was $48,000 and they produced more than that in interest in 2 months. I was like, what do you want to do with it? Their response was, I don't know. I was like, who do you want to give it to? They just rattled off 16 charities, and that's what we did, because they don't spend money. Now, if you're from Wisconsin, that's typical. If you go down to Florida, that's not. All right. So, and the last thing is, what do we start to look at? How are we understanding where's the income generated now and what type of income is it? So I talked about consulting, solo 401ks. I talked about cash balance plans. But then what type of income are your investments producing? Obviously, everybody's familiar, municipals produce tax-free income. But, are you invested in private equity? What type of income and how's that private equity kicking off income? Are you invested in private credit? Where's that income coming from and how do we balance that all out? Because there's a happy medium, right? You don't want the tax tail to wag the dog, but we want to be efficient with the way that we take these proceeds from the business. And so let's pick on this. Taking a loss in your portfolio. People hate that idea. It drives me nuts. Taking a loss is not a bad thing. If we take a loss at the right time, it's a great thing because then we can offset gains. So if you were one of those lucky people who invested in NVIDIA back in 2020 and now you're up 2,000%, well, now you're overweight. You're looking at a position that has a lot of concentration risk internationally. But let's just say you bought GE stock and then it split and it's gone negative and you have $100,000 in losses we can take. Let's sell the GE stock, take $100,000 in losses, sell the NVIDIA stock, not pay taxes. Or not all of the NVIDIA, right? But sell $100,000 in gains in NVIDIA and balance that out. That's options you can do. Part of my career I spent at Russell Investments working in the tax managed equity space. The days that we got most excited were the days that the markets dropped the most. The day the market dropped the most in my career at Russell was the day Brexit happened. I was driving to Champaign, Illinois, listening to Bloomberg in my Volkswagen CC. And all I could do was get on the phone and start calling everybody at Russell and saying, how much did we harvest today? It was awesome. And then within 3 days, the market bounced back. It was a Thursday. By Tuesday, the market was back to where it was after the actual Brexit announcement. And then when you start talking estate taxes, and I already mentioned, death is a strategy. It's not the best, but it works. I mean, we do work with people who are just like, I'm going to die. It's my kids' problems. I wouldn't recommend that because at some point we have to deal with that too. Like it doesn't just impact your kids, it impacts everybody else, your attorneys. We're all dealing with everybody fighting. It's not fun. All right, and then you get into the stuff that matters, the estate.
I'm going to steal control from you if I want to drive.
I want to.
Okay. One of the panelists up there, and he's actually in this room right now, mentioned going through the options of who wants a business. That is the first place you have to start. That oftentimes has the biggest impact on an estate plan. A lot of business owners, particularly in Wisconsin, are small business owners, and they're thinking that their kids are going to want it, but they never bothered to ask. You have to start there. First of all, does anyone even want the business? If you start with family and they don't, now you've got to move to the next option. Is there a key employee or maybe if you've planned enough in advance, can you hire and bring someone in and start looking at it that way? If that doesn't work, then you're looking at third parties or private equity. So step number one is who wants it. Estate planning comes in, a lot of times it's who's getting the property after you're gone, but an equally important part is how is that transition going to happen? If you own a business with someone else, all of the owners have to be involved. LLCs have operating agreements. S corporations have bylaws. Can you transfer your shares in the business to someone else? A lot of people use revocable trusts. Sometimes there's restrictions in those governing documents about who can actually inherit your property or where it can go. You've got to make sure operating agreements and bylaws align with what your estate plan is and align with what you and your other co-owners want to accomplish. There's also a lot of different strategies. Brandon mentioned tax planning strategies for the sale. Is it going to be a lump sum? Is it going to be a stock sale? Is it going to be an asset sale? You can also gift property, right? If kids are going to be involved, gifting is an option. For some people, it works great if they just want kids to inherit and the plan is for family to carry on the legacy. Sometimes it's not. You can also do combinations of sales and gifts. So you have to look at all of the different options. Biggest pitfall with this, and it's up there on the screen, is if one person gets on the ball and gets their estate plan in place, they get all of the trusts in the world done, they take care of their shares, and they have an equally important owner that doesn't do the same, and that person passes away with nothing in place. It can cause a mess. So you have to start planning with this in advance. All right, we've talked about a lot of this, but Uncle Sam's going to get their share. Tax planning isn't necessarily how do I avoid taxes, it's who's going to pay the tax, when, and at what rate. Uncle Sam's going to get their share. Tax planning is figuring out how that's going to look. I imagine many of you have heard of the Tax Cuts and Jobs Act and know about the sunset that's coming up, barring any changes, January 1 of next year. We don't know where that's going to go, but it's something to keep an eye on. It's going to affect not just estate tax rates, but also income tax rates.
Just on that note, with the Tax Cuts and Jobs Act, this is just my personal opinion as it currently sits. It was supposed to be done within the first 100 days. It hasn't even been addressed. So currently what my expectation, and I would argue, Alec and I are on the same page, it'll probably go down to the wire. It'll probably be, a 12th hour passing if we're lucky on December 31st, or what they've done in the past is they've actually let it expire, gone back and prorated everything in like February or March. Your CPAs hate it.
I hate it.
Everybody hates it. But right now it just does not seem to be high on their agenda. It doesn't mean it can't pass sooner, but it's not getting the talk that we thought it would coming into January 20th.
This is just, what the current tax rates are for trusts and estates, individual filers and married jointly. Trusts and estates, where's this pointer thing? Oh, there we go. When we're talking trusts, it's primarily irrevocable trusts. I don't know how many of you in here have an estate plan in place. Hopefully everyone.
Hint.
If you have a revocable trust, that is not going to be subject to this rate. This is for irrevocable trusts, which are separate tax entities. All right, so Tax Cuts and Jobs Act, this is what I was talking about with income taxes changing. The Tax Cuts and Jobs Act was passed in 2017, and it consolidated some of the tax brackets. That's changing effective January 1, 2026, assuming nothing changes. The amount of taxation will stay the same, again, but additional brackets are going to be added. So basically, you can look at it as a 3% tax hike. I don't expect all of you to read this. Please don't. If you want these slides, we can share them with you. This is just saying that a lot of the Tax Cuts and Jobs Act changed other tax provisions. One of the more common ones that was used by a lot of people itemizing their taxes was state and local income taxes. That got capped. That's a big one. There's a lot of talk among experts that if anything happens in 26 or at the end of 25, estate taxes might stay high. State and local income taxes might come back. President Trump's actually mentioned that, or at least bringing some form of it back. So every CPA, estate planning attorney, and financial advisor that I know is keeping an eye on this, but you guys should keep it in mind as well. If you don't have a team of experts, please get one. Again, this is just standard deductions raising, not a huge thing to read right now. This is the big one. This is what a lot of you guys are concerned about. Everybody wants to know what's going to happen with death taxes. The nice name is estate taxes or the estate tax exemption, but everyone calls it death taxes. Wisconsin does not have a state level version of this. So anyone in this room that is a Wisconsin resident, you only need to be concerned about the federal limit. Every person has a lifetime exemption. It's currently $13.99 million per person. Brandon mentioned death as an estate tax planning strategy. Works better if you're married, but it can work as a single person. Wisconsin doesn't have the best income taxes, but it's a pretty nice place to die in for married persons. We are a marital property state. We're one of 9.5 in the country. Florida's different. It causes everyone headaches, but 9.5. What it means is the law assumes everything married persons own is owned equally, regardless of how it is titled. Biggest benefit of that happens at death. One spouse passes away, there is a step up in basis on all marital property. Because Wisconsin is a marital property state, that step up is 100%. It can eliminate all capital gains that married persons have on their married property. Again, That's where death taxes or death as an estate tax planning strategy works better when there's a surviving spouse that can liquidate those highly appreciated assets with minimal capital loss or minimal capital gains. In addition to the estate tax exemption, there's also gift taxes. Those are unified. So this $13.99 million exemption, this is what is in your estate at the time of your death, plus how many reportable gifts have you made during your lifetime. Just because you gifted someone money does not mean you need to tell the IRS, does not mean you're going to pay taxes on it. That is what this column here is saying. In 2025, you can give up to $19,000 to as many different people as you want to without having to pay any taxes or report that to the IRS. This gets into that charitable planning. Also, if you have a bigger family, grandchildren, individuals that are going to go to higher education, medical expenses, you can make some gifts directly to those institutions and persons, help reduce taxable estate in the long term. This might not be something done in a document, but it is worthwhile planning that heavily impacts not just a financial plan, but an estate plan.
You probably wonder, like, oh, we're talking about selling a business. Why are we talking about this? Because if you're selling your business and it's, say you're married, so we're at 28 million thereabouts, and your business is worth 40 million, you're $12 million above the federal estate tax exemption amount, meaning that $12 million is going to be taxed at 40% if you both passed away right then and there. So 40% above that, it's just gone. And you have 9 months to pay it. And if you are like a lot of individuals, there tends to be a lot of property, right? You own homes, you own things like that. It's really difficult to liquidate that stuff quickly. The IRS wants their check in 9 months. So we unfortunately had an instance where somebody's estate tax was $16 million, and the actual liquidity that was available was that amount. There was a lot of property, but all of it, we had to just write a check for all of it and give that to the IRS. So there was no liquid assets available for the heirs. So we had to go through the process then of liquidating properties that had sentimental value or income generating opportunities to cover down on the other expenses that were associated with what we had to go through in that estate. Now that's not necessarily normal, but that happens. That's why this discussion is so important.
It's also where aligning the estate plan with exit strategy comes into play. If you have a trust out there and you don't have your business interests in the trust isn't really going to help you when it comes to liquidating that asset, right? If you have an estate plan, you want your interests to be held within that estate plan so that you can maximize not just how assets are going to pass on death, but how it's going to flow during life as well. All right, we talked a lot about this, but charitable giving is oftentimes one of the biggest opportunities. Given the current tax environment, it's oftentimes the only option. Annual exclusions can be a big one. Education and medical expenses, if paid directly, do not count towards annual exemptions, so you can actually give more than that $19,000. If, for example, there's children that are going to college, grandchildren that are going to college, you can pay those expenses directly. There's a lot of options when it comes to trying to defer or choose when and how someone is going to pay income taxes. You'll hear a lot about irrevocable trusts. There's a whole bunch of different options available for that. Some of the most common ones are SLATs, spousal lifetime access trusts, dynasty trusts, and GRATs, grant or retained annuity trusts. These are not going to eliminate the need to pay taxes. They are choosing who is going to pay the tax. I want to talk about this one a lot. SLATs were really common before the Tax Cuts and Jobs Act, when estate tax exemptions were a lot lower. There was more opportunity to gift during a lifetime and help defer appreciated gains. Given how high the exemptions went, especially for business owners, these became a lot less common. You might see a spike in those if exemptions fall. Just to show how they would work, SLATs are basically spouses. It's really the only people that can do this. Both set up separate irrevocable trusts, and they gift property into that trust. It is used for the benefit of their spouse. For example, with a business owner, if you and your spouse are co-owners, you can gift your interest in that appreciated asset to that trust. Your spouse can do the same. It can then be used for the benefit of that spouse during life, and at death, it'll pass to a further beneficiary. Oftentimes, these are going to be designed to be grantor trusts. Grantor trusts are irrevocable, but can provide a double tax benefit in one, getting assets out of someone's taxable estate, but also an income tax. We'll get into this a little bit, but trusts pay taxes. You got to decide who it's paid. With a grantor trust, the person that creates it is paying the income taxes. This is an example of how a slat can help. Left example is no slat. Right example, you've got a slat. In this example, we're assuming someone has a $50 million net worth 2 years ago. They gifted $10 million to this trust in 2023, and the person dies about 11 years later. If they had done slats, it saves them about $25 million in estate taxes. Again, it's not going to completely eliminate taxes, but it can help defer growth in taxes down the line. That's a lot of numbers. Any questions on that? Okay. So coming down to who pays the taxes, you've got three choices. Trust is going to pay the tax at that compressed bracket that I showed you earlier. The individual that created the trust is going to pay the taxes at their personal income tax bracket, or the beneficiary is going to pay the taxes at their personal tax bracket. It depends on how the trust is drafted. This is where, if you're planning an exit strategy and long-term or legacy planning is a goal, children want to inherit, this can become a lot more beneficial. You got to decide who's paying the taxes, though. There can be a great double benefit with the grantor reporting income taxes on their bracket. You can help defer the growth for the beneficiaries and allow them to inherit property tax-free, while also allowing an income tax deduction, or at least income taxes to be paid by the person that created the trust, which can help reduce their chances of them paying estate taxes on their death. It's not going to work for everyone. You've got to talk to your attorney, got to talk to your CPA, really got to talk to your financial advisors too. Sometimes this just isn't the right choice. Sometimes people don't care about paying the estate taxes because there's not a legacy there, or it's small enough that they feel that their estate's liquid enough to pay it. That is a strategy. You know, I've seen clients that don't care that there's an estate tax that is owed. They're fine with their money paying it. They feel that it was a benefit to their children or their charities, and there's not a concern. So decide what your plan is first, then implement it. Again, this is just kind of reiterating who's paying the taxes, when, and how is it. When you're putting assets into a trust, when you're thinking tax planning, it's usually an irrevocable trust. Usually, if you're going to do that, you want to put in a highly appreciated asset. It's going to have a low basis, high amount of growth. You want to make sure that that's passing to someone with the least amount of taxes to that person ultimately. So there's a lot of planning that goes into that. Sometimes you have to do a buyout. Sometimes you have to sell an asset to it. But it's possible. No way to avoid taxes. It's just who's paying it, when, and at what rate.
Yeah, so when you start to think about charities, so if we don't want to pay those taxes and we don't want to be in that situation, we don't want to do a spousal lifetime access trust or some sort of irrevocable trust, your options left as of today is charity. Well, if you've done a great job saving, but you've been using 401ks, IRAs your whole life, because let's face it, there's a generation there that was given one option to save, and it was a 401k, and those turned into IRAs. The Roth IRA came out in 1998. Roth 401ks were like late 2010s. So, you know, if you're in that age bracket where you're getting close to retirement, you didn't have a lot of opportunities to save anywhere else besides a 401k or a brokerage account. So what's the best gift to give to a charity? It's your IRA. If you have a big enough estate and you have, for instance, a $3 million IRA and you want to be charitably inclined, and I'm talking about on death, if you want to not burden your children with the tax liabilities of passing on an IRA, which has to be withdrawn out over a course of 10 years with required minimum distributions over those 10 years, give that to charity. Don't give out of the non-qualified assets or the regular cash that you have. Give that away, because the charity's not going to pay in the IRA. You didn't have to pay in it. You got to defer it. That is an option. Before you die, you can do what's called qualified charitable distribution. So you hit 70 and a half, and you can take from your IRA, and this year it's 108.
For QCDs? Yeah.
So this year you can take $108,000 from your IRA, move it over your tax return. I like to draw a picture because you have your tax return in the middle, right? Anything you take out hits your tax return, then you pay taxes. With a QCD, it goes over the tax return, doesn't hit it at all, and it goes right to the charity. Charity doesn't pay taxes, you didn't pay taxes. If you're over 73 or 75 and you're in that required minimum distribution age, that beautiful age where the IRS tells you whether you want to or not, you're taking money out of your IRA, and it's $108,000 or less, you can give all of that to charity and still satisfy your required minimum distribution. Why is that important? Because if you sold your business and now all of a sudden you have an influx of 25, 30, $40 million, and let's just say for ease of math, you're earning 4% yield on that. Well, all that income's coming into you. Why do we want to add another $108,000 of required minimum distribution income? Why not give that away? Why not look for different strategies to be efficient? You'll never get away from the tax man. So I explained to somebody this morning, they had a very large gain. They said, look, you made money. So what? We made money. That's the good thing. We have to pay Uncle Sam. If we weren't paying Uncle Sam, it means you didn't make any money. Nobody's going to be happy about that. The other thing you look at is donor advised funds. These have become really popular because they become so simplified. It's a beautiful tool that just allows you to open what's called a donor advised fund, open it up, put the money in there, particularly appreciated stock. So I pick on that NVIDIA thing. You bought NVIDIA in 2020. Now you're up 2,000%. What do you do with it? You can move it over into the donor advised fund. As long as it's long-term capital gains, you can wipe that out. That's, you give $100,000 and your basis in that $100,000 is $100. You just gave $100,000 that goes on your tax return on your Schedule A. It's an opportunity to move highly appreciated stock out. And if you're in an installment sale, you have that money coming in from the installment sale, you're giving away that highly appreciated stock, you're resetting your basis, you're buying NVIDIA again, all sorts of different planning strategies around it. So the key is you want to donate and you want it to grow, and then you can choose when you give it away.
There is other options on this list, private foundations, split interest charitable trusts, whether that's a charitable remainder trust or a charitable unit trust. There's a whole bunch of different options. Donor advised funds have become more possible, to Brandon's point, because of their simplicity. You don't need to get an attorney involved. You typically aren't going to be paying or having to take investment income out of it. The biggest advantage is, one, simplicity. Two, you can control where the money ultimately goes. You see a lot of people using these, particularly in high income tax years, like the sale of a business. If you have excess income, you can take that and contribute it to a donor advised fund as an income tax deduction, which can help offset the massive gain from the sale of a business. There are limits on how much you can contribute to these things. That's in here what the deduction is. The nice thing with the donor advised fund is you can do carry forward. You can carry forward excess charitable contributions for up to 5 years. So if you plan on giving $20,000 a year to charities over the course of 5 years, if you want to get a better income tax deduction in year one, instead of doing $20,000 every year, you could put $100,000 into a donor advised fund in year one and distribute $20,000 in each of those next 5 years. But you got to add that $100,000 contribution as an income tax deduction in year one. This is, we talked about QCDs. They can be a great option. They're not always a great option. The nice thing about this is you can satisfy an RMD without having to recognize income taxes. When I'm talking about bunch deductions, that's what we're talking about with the sale of a business, super funding a donor advised fund. You can do the same thing with a private foundation as well. The biggest downside with private foundations is there's usually more operational expenses. You tend to see these more when family wants to get involved. If you have a younger generation that's highly invested in charitable giving as well, or philanthropy as well, charitable foundations tend to be a lot more useful. It can get family involved within your charitable giving planning. The downside is there's just more expenses associated with keeping them running.
Yeah, so, kind of wrap this up. When should you be looking at doing this? Right away, right? You start to plan for this. You start to think about all of your stuff at one time. Okay, what do we want this to look like? What do we want our legacy to be? What could this potentially be? Is the business set up properly? Is there a next generation? These are all things that you need to do, and have that succession plan in place right away, because you never know what's going to happen tomorrow. And if you don't have a plan in place, and heaven forbid something happens, it can leave a real mess. And that legacy that you spent the last 20, 30, 40 years building and pouring everything into, and missing those kids' games and missing plays and all of that, could just be thrown out the window because you didn't have proper planning. you've built a successful business, get some experts, some great CPAs, attorneys, planners to help you make sure that you can continue that legacy for the rest of your life. On to perpetuity, I should say.
This is just things right now, but to Brandon's point, start thinking now how you want it to happen later on in life. Is that a transition to family? Is that selling to employees via an ESOP? Is it going the private equity route? Is there a third party that, a strategic partner that you want to sell to? Think about those things ahead of time. There's nothing wrong with deciding when you want to do it. You could sell now. You can decide you want to hold it and pass it on death via an estate plan. You can do all of these things that we've talked about, a sale, a gift, a partial sale and partial gift at death as well via an estate plan. You just have to decide how and when and where things are going to go.
So the last slide that we have is just kind of all the different things that Annex itself can help you with. As you look to private client, which is the team that I head up, these are all the different areas that we function in. But Annex has got a great team. We're always here to help. You can reach out, ask us questions. I know everybody wants to go, cure the hangover from yesterday by adding more to it. So feel free to do that now. But if you have questions, don't hesitate to ask myself or Alec. We'll stick around here for a little bit. Mark Beck is in the back. Austin is in the back. And I think somebody else from Annex was here.
Lisa's here, but she's not in the room.
Thank you. Lisa's here. So feel free to ask anyone else questions. So appreciate the time. Thank you.